Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
All right, everyone. Welcome to the show. Pleasure for you to join us as we try and navigate this crazy world of property, particularly crazy at the moment. There's quite a lot of noise in markets all over the joint about what's happening and where we're going as a nation and how our property market's going to fare in the future. And it's some big issues here. There's macro, there's microeconomic factors. There is everything from a street level and a house level all the way through to large suburb levels or state-based levels. Markets are moving in very different ways. And I'm trying to get ahead of it and across it. And I struggle myself, even though I can pick up the phone and speak to anyone in property in Australia. So I'm with you. We're just trying to understand how this current market is going to evolve over time and whether or not the property market as we knew it is going to be different moving ahead. I'm not too sure, but I think the guest I have in the studio today is going to shed some light onto me. So this is me essentially learning about this myself. So you get to join me as I navigate this conversation with Dr. Andrew Wilson. He's the chief economist at My Housing Market. You've probably heard of him before. He's on and across the media offering commentary, and he has done for many, many years. I've known Andrew probably for 10 years across all the different media products I work across. So I'm looking forward to this chat. Andrew, how are you going?
I'm good, Phil, and thank you for that introduction. And yes, it has been a few years.
It has been.
We've been chatting about the market, and the interesting thing is, I guess, as you sort of alluded to, is that we shouldn't expect things to stay the same. And in fact, at the moment, that expectation has really hit ground zero because I think we're in a very different environment now.
We are. And change is good. I'm okay with change, and I've learned to embrace change.
Yes.
So I'll look for opportunities in this market. But before we start chatting about the market, what does a chief economist do?
Well, I guess something higher than a senior economist who works at a
And a
higher
junior
level than an
economist.
economist. So, but that was my role when I left Domain as chief economist. And in a sense, it's, I guess, a brand you or a role you carry forward. So I'm particularly interested in, I guess, data analytics. In a previous life, I was what is regarded as a quantity surveyor in my economist role, and I worked in commercial, and I'm a member of the Royal Institute of Chartered Surveyors. So measurement is I guess a significant part of what I do, my skill sets. And of course, measurement covers a lot of factors, not just the measurement of construction, but also the measurement of markets. And I think that's what is my particular obsession. And moving out of Domain, where I was for the best part of 8 years, and Australian Property Monitors, has given me, I guess, some opportunity to pursue my passion, which is to produce some more particularly real-time and robust models of what's happening in our housing market. So look out for that in the future.
Yeah, so you get excited over spreadsheets too and data sets.
I do.
Well, what do you
somebody's got to do it.
Well, what is it though? Why do you? Because I chat with sort of demographers, yourself included. I guess you're a demographer, you're an economist. It's different again, but you sort of wired a particular way, you guys and girls.
Yeah.
Like there's something that you really get excited. So do you just look to uncover themes and trends that
Absolutely.
you can extrapolate out and give some science or insights? Is that pretty much what you do?
Well, I started my journey off, Phil. I was actually firstly a real estate agent, and then I was very young. I was a valuer as a very young youth many years ago. I won't say how long ago, but I then moved into academia because I always had this interest in research, and I guess research is problem solving, isn't it? You want the answers, and it's about puzzles and unlocking the mysteries of things, and particularly in markets and economics, I found because of the vagaries involved in that was especially challenging, and also sort of interested in mathematics as well and logic, and it sort of all came together. And I had a 15-year career in academia, and that's where I did my PhD, of course, research, and I worked as a senior research fellow, and I was engaged in a lot of, I guess, high-level research through academia, and then I moved into industry eventually. And research in industry is a lot different to research in academia. It has much shorter lead times, and I guess it's about, we need something here and now, and we can't wait 3 years. And I guess it has to be a balance, because sometimes if you do wait 3 years for research, the carnival's moved on and it's not quite as relevant. So I've tried to sort of get between those two scenarios. But, econometrics is what or econometrician is what I guess.
Econometrician.
It's what I regard myself at. And that's the measurement of economies and economic markets. So it looks at time series and tries to unravel that underlying, I guess, noise that generates markets and market activity. So yes, I guess that's my particular passion. But it is, I think, when I think about that, it's about unlocking, the puzzle or the uncertainties that that markets have, and trying to find ways of getting, I guess, at least as much of a real-time insight into what's happening in markets. And of course, markets, particularly housing markets, are just a product of human decision-making, and none of us can predict really, that at a granular level. And all that happens in terms of larger market activity is you put together all those buying and selling decisions and try to come up with something that's, driving all those decisions at a common level. And, it can be quite challenging to come up with sort of rationale in real time, as we know.
Yeah.
And I guess it's the fact that there are all those uncertainties involved in the measurement of housing markets and the economy keeps it very interesting, and it makes it challenging.
So you talk about uncovering mysteries and puzzles, and also, I get what you guys do.
Yeah.
I find it quite intriguing, the way that you can maneuver through data sets and actually pull out some findings. But you're talking about uncovering mysteries in markets, and, and you've been in many markets.
Yes.
Property markets go through cycles,
yes.
which I showed about a lot on the show. But is the market that we're in right now more mysterious than previous markets?
Well, look, it's different. Whether it's mysterious or not, I don't think it's that mysterious. In fact, I think the positives of this market environment now is we're actually going to move into an era of more certainty and predictability. So I guess that ticks really all the boxes if you are involved in property, is if you have more certainty and predictability. And the reason we have that going forward is because we have more certainty and predictability about the key force, particularly in our property markets, and that's interest rates. Look, we've had interest rates now on hold for over 2 years. This is official rates, of course.
Yeah.
That's a record period with rates on hold through the Reserve Bank. We've also had nearly 8 years of rates without a rate increase, and that's also a record. So we're into this period of a very flat environment for monetary policy. And the reason is that monetary policy has failed in its role, which was to re-stimulate the economy. Of course, interest rates were cut or started to be cut in 2012 as a response to the end of the mining boom. Reserve Bank, wanted to re-stimulate an economy which was suffering the drag from the end of that, remarkable economic period. So we cut and we cut and we cut, and other than a boom in Sydney and a semi-boom in Melbourne, really nothing's happened to the economy. And this has been a conundrum worldwide that interest rates in some economies, even down to zero, have failed to produce the results in previous stimulus periods. We have either fiscal policy, which is government spending to stimulate or to control our economies, or monetary policy, which is controlling the cost of money. These are the two key tool sets that governments use. Now, perhaps the fact is that there's been too much fiscal policy used, and high levels of debt has meant that we've been more reliant on monetary policy. But monetary policy has failed to come up with the outcomes traditionally that we've relied upon to re-inflate economies. Now, the interesting thing is that we've had two parts of the holy trinity of outcomes from lower interest rates happen, and that's been stronger labour markets and also higher prices. But we haven't had any growth in incomes. And this has been the real, perplexing outcome from lower interest rates. It's not just in Australia, it's in all the other advanced economies. So you've got lower rates, but incomes haven't responded. So what traditionally is supposed to happen in theory, and I always say you can't look at economics as a statue. It's not something that's got fixed rules and it just works that way all the time. It changes as humanity changes. So we had lower interest rates, which is supposed to mean that people have more money to spend because they're spending less on their mortgages and less on their credit card and, less on their overdraft. So they go out and spend more, which means that companies have to produce more, which means that they need more workers, which means workers then start to get competing for particular jobs, or employers have to compete for workers. They get paid more, and then workers have to say, we're paying more wages, so we'll have to put up our prices to cover those increased costs.
And everything marches on.
And then everything marches on and prices rise. But it didn't happen this time.
So let's have a quick chat about that. You've talked about really quickly some quite complicated economic...
Yeah, so I hope I'm not getting too deep here.
Economic policy.
I need to take a breath anyway.
Talking fiscal policy, monetary policy, you're talking about wage growth.
Yes.
You're talking about how confidence stimulates markets and therefore champions growth. So if you're going to hard mark the government in place right now, so you've gone Rudd, Gillard, Rudd. Then you've gone Abbott, Turnbull, Morrison.
Yeah.
So we're talking a period of 5 to 6 years, 10 years, for example. If you're gonna mark the government, as in irrespective of who they are, on monetary and fiscal policy for trying to achieve what they wanted to achieve, have they done a good job?
Well, look, I think that, it's always a learning experience from governments because they have to be ahead of the curve, but you can't be ahead of the curve because, as we've just discussed, what if the whole dynamic has changed? I think that what we, I don't have any particular, we can look back in retrospect and it's all fine to be experts in hindsight.
Yeah.
But, I think that we needed more cuts in interest rates 2 years ago. There was a sense that overinflated housing markets, particularly the Sydney housing market, was at risk. We had a lot of talk about some, fanciful bubble emerging in house prices. Of course, we had no experience of this type of an outcome in our housing markets ever. So it was more, or certainly theoretical, in terms of being concerned about pushing interest rates down further and at risk at some, out of control housing bubble that would crash. And of course, the only reason a housing bubble would deflate would be through higher interest rates. And of course, we haven't seen any sign of higher interest rates.
Are we going to
since
see
then.
them in the future, though?
No, I don't think we will. In fact, I think the Reserve Bank, and we're seeing, and I've been saying this for a while, and we're seeing others now join, in my opinion, that I think we may see a cut in official interest rates next year. If we don't see incomes rise, we're going to have to find other ways of re-stimulating our economy. We're getting money into people's pockets. The concern now is that consumers are delving into their savings to support consumption. We have the savings ratio now at its lowest in over a decade, and that's not good news. It's not. A decade ago, people were delving into their savings at high levels because they were spending like drunken sailors, prior to the GFC. Now they're delving into their savings because they've got nothing else to spend.
The challenge, though, if there is an interest rate cut to the official cash rate, and there is a difference between the official cash rate, the RBA official cash rate, and what you pay on your mortgage.
Yes.
If they cut rates, if the Reserve Bank cuts rate, it doesn't necessarily mean your mortgage is going to go down, though.
Well,
your
it
mortgage
doesn't.
may still go up.
No, well, that's true. But the point to that is it will clearly signal to the banks that they have to ease the market. I mean, there's always political pressure that banks have to follow interest rate policy up or down, and obviously they're quick to follow it up and a bit slower to follow it down, but that's the nature of the beast. And I would hope that one of the resolutions of the Royal Commission, which has really got my head scratching at the moment, is that we can start thinking quite clearly about the relationship Australians have with their banks and the relationships that banks have with the general economy. I'm not sure that public good argument, which I think banks should be focused on, particularly, is being met. And I think there's something the Royal Commission needs to start thinking about. Where does the public good fit in here, particularly as we're seeing quite concerningly now this sort of out-of-cycle rises for a start, even though they're marginal, but also the tightening of credit, which is a real concern.
Well, it's a big issue, and we've been chatting about it on the show for quite some time. It's getting harder to get money, right? But let's go back to some of these policy levers, okay?
Yes.
Let's look at the outcome. Most people care about the outcome, right? Most people can't control this stuff, right? They just got to be a recipient and work out what do I do about it. You can vote, right? And you're going to get a chance to do that next year. So do you feel as though the monetary policy put in place to restrict lending from the banks from APRA, tightening of credit, essentially slowing down interest-only loans, on the basis that property markets were going up too quickly and we needed to temper it. Has that been effectual, number one? Or number two, do you think the policy was wrong and it's now put us in an environment which is where we don't want to be?
Well, I've been a clear and public question that policy. It was all predicated on the risk of higher interest rates. Well, how's that gone?
Yeah,
we haven't had. It was introduced back in 2015. These sort of newfangled macro-prudential policies that were all the favour then amongst policymakers, and APRA decided to become a part of that. Of course, New Zealand started the ball rolling. The sense was, we've got a strengthening property market here. As usual, we saw a higher level of investor activity, which always happens in the cycle. Investors are attracted by higher prices, which then pushes prices up and attracts more investors, et cetera, until the cycle peters out, and then we see fewer investors. But APRA decided to move ahead of the game and to cull investor numbers by obviously restricting lending and putting up rates. Now, the risk from them was that if rates rise, it would have an impact on the market that they wanted to control. Well, that was a speculation in 2015. Well, we're 3 years on, and if anything, we're in an environment now where the question marks are, will rates fall. So that particular model of prospective higher rates was proven to be false. But of course, it has dragged the market down. It's created the momentum for lower prices. And now my concern is that we're getting locked into this, crisis of confidence from buyers and sellers. And we're also seeing, banks rock into this type of mindset that for some reason they need to be extremely risk averse or more risk averse in terms of their lending policies. And yet the key drivers of just about all our state housing markets now are in the positive. We're still undersupplied over the longer term. We have strong demand and strong economies, the lowest interest rates we've ever had.
So that's good though.
Absolutely.
That's what I was a good step. But do you think if our policymakers could go back in time to 2014, 2015 when they were the genesis of these ideas around shaping investment lending, do you reckon they would do the same thing?
Well, the role of the Reserve Bank is clearly independent of that of government.
Yes.
And that's what Paul Keating, when he introduced an independence of the Reserve Bank, and that's fine. But, we've also had other policy initiatives that have come through recently. And look, governments can only respond to, I guess, the models and the experiences of the past. They can't, I guess, be as adventurous in terms of their policy making based on speculation that perhaps we are into a new environment because they have responsibilities. But it's unfortunately just a question of suck it and see going forward for your policy scenarios. And, we're still a very fortunate country here, and I'd rather be here than anywhere else in terms of our economy. And we're going to go through a period of settlement and uncertainty in our housing markets, make no mistake, which is accelerating to my concern at the moment until we hit sort of ground zero and rock bottom. But I don't think we're going to have any cataclysmic fall in prices.
So let's drill into this then. So you talk about the new environment, which
Yes.
is now, this is just the environment now, right?
Yeah.
It's just going to be like this.
Yeah.
Now,
Well, nothing's going to change. This is what I say. What's going to change? You tell me. What are you frightened of? What's going to change? Interest rates? No. The economy? No. Nothing's going to change. The only thing to fear here is fear itself, and that's a truism or a cliche, but it's certainly affecting markets at the moment. And we've always had this sensitivity to housing market dynamics, and it's part of what underscores a strength of our housing markets is we have this great regard for the sanctity of housing as investors or owner-occupiers. Aspiration for home ownership is very strong in this country, and it's part of, I guess, our immigrant background, where maybe we wanted to create a society where you could aspire to be a homeowner, that it wasn't a complete impossibility. And that's part of the great egalitarian society that Australia is. And that's why we are very sensitive to any signs or predictions of a shakeout in the housing market, even if they're, basically nonsensical.
Yeah, so this is really important to me because I stand behind this microphone. We have nearly 100,000 people listen to this thing every month, right? So I've got a lot of property investors that listen to Phil Tarrant. So I'm conscious about how I choose to approach my narrative and dialogue around the property market, right? I'm pro-property. I'm pro-property investment.
Yeah.
I think it's a great.
Well, why wouldn't you be?
It's a great wealth creation tool for Australians, right? That's where I come from, right? So as a property economist, someone who lives and breathes this stuff, what should be the conversation I should be having with our listeners? Should I be, guys and girls, interest rates aren't going to go up.
That's right.
We have a strong economy.
Yes. Migration, we have the strongest, we have the highest the highest rate of migration per head of population of any country in the world.
Okay, so these are
they got to live somewhere.
These are all good points, right? We have undersupply, long-term housing supply. We're going to struggle.
Yes.
So these are all good things.
Absolutely.
Okay, but on the other side, we have these stuff which are a bit unsure.
Well, that's
sentiment.
And that's short. Sentiment is always a short-term driver of the market.
So this is the crisis of confidence. It's sentiment.
Exactly.
Sentiment.
Exactly.
Sentiment.
And unfortunately, because we don't have these external drivers changing things for us to, I guess, become a little bit more positive, it'll mean that it'll stick around a little bit longer, the negativity, because nothing's going to change.
So what's my messages then? What should I to give our listeners the information they need to make more informed property investment decisions? What should I be saying?
Well, look, nothing's going to change. Okay. So I think that in terms of the key drivers, our economies will remain strong. Migration will remain high. We will still have significant roadblocks to new supply. You've got to understand that most of our rental markets are as tight as all hell, except the Sydney market. which has gone the other way, not strangely, but because of a number of predictable factors. But it'll rebalance eventually, because this Sydney market still remains, a market where demand will always surge ahead of, or always be ahead of supply, only because it's the strongest economy in the country. But as I said, so going forward, if the key drivers are all remaining the same, you've got to start thinking, I think investors particularly have to start thinking about, well, it is a different market environment. We may go another 2 or 3 years, and you cannot, it's always difficult to go even more than 6 months out in terms of economic policy. Look what's happened in the US over the last 6 months with tariff changes and significant tax cuts to corporates. But, given the current environment, having had over 2 years of rates on hold, that, now most of the analysts are saying at least 2020 before we'd even think about a rise in interest rates. So what I'm saying is we're getting this much longer, and the longer it goes, the less it's likely to have an impact anyway. That's the point, because we get used to the stable environment in terms of what monetary policy does. There's no movement, and this is the end of the cycle, what I'm saying. So I think that the change to this means that it changes the dynamic for property investment, residential property investment. I think what you're going to see going forward is a different view of property residential investment. It'll be strong. We still have it, immersed in our DNA, the sanctity of bricks and mortar and safe as houses. And as I said, that gets back to a lot of our immigrant background and our regard for property investment as being the roadway, as you suggested, to wealth and success and prosperity and safety. But I think that going forward, we'll start looking more about the yield on property and residential investment rather than the highs and lows of capital growth, which have always been a hook to investors. As I said, the cycle always rises on the back of, speculative investors wanting to get in on higher prices. But if we take that sort of roller coaster ride out of it, we still see that residential investment offers tremendous positives. And that, of course, is yields that are highly tax advantaged. And which are
for the moment, but
well, we can talk about that too for the moment, but certainly they will remain tax advantaged. So what happens with residential real estate, in my view, it becomes more of a commercial real estate play. Now, we've seen a bit of a swap around between commercial and residential depending on how the cycle evolves, and we do see a switch back to commercial, smaller scale commercial investment once the heat goes out of residential investment. But if those two markets or those two asset classes start to look the same, I think we'll start to see a lot more interest or focus in residential investment on yield returns together with capital gains. So you'll see a net, an overall return of, I still say, a couple of percent, even in a flat interest rate environment for capital growth in most capital city markets, plus 3%-ish yield. You're still getting 4 or 5% return on your investment, which in an economy which is not returning anything at the moment, this low yield economy, low growth, low interest rate economy,
it's not a bad
and it's bricks and mortar. It's an asset class which is a concrete asset class per se, rather than the volatility of shares and the vagaries of other assets. And it's something we feel comfortable with anyway. So I think that we'll see part of this certainty and predictability in terms of our cycle and our economy going forward, particularly in regard to interest rates, is more of a change in the way we look at residential investment. So I think that we're not going to see the wave of investor activity. I think it's going to settle quite nicely at around about 45% of activity. Okay. But it'll be more about being, turned on to yield plays, which are medium to sort of longer term strategies. And we're already sort of starting to see that in another way with changes to the tenure laws for tenancies, right? That they're now becoming longer. And of course, if you do get a longer tenancy, that's a good thing for the landlord. If they're working on a yield play as being important, it means it becomes a lot more like commercial, where you do have a longer lease environment. And I think, as I said, it just changes the nature of that asset class, and I think it's a positive, and it's actually in a way a bit of a lifesaver against this sort of grinding low growth economy if we don't get incomes rising.
Most property investors, they think about the immediacy of their portfolio right now, and is my property going backwards in value? Every investor I speak, is my property going backwards in value? Melbourne, Sydney, or wherever you are invested. Is that the wrong way to be looking at it? Is it, if you're able to hold on the property long term, you're probably going to be okay. Don't think about immediate drop of 2, 3, 4% in your property value.
Well, it's only a drop in value if you sell, isn't it?
Yeah.
And that's the point, is if you sell, you're not an investor anymore. You just got your money in the bank. So investors are there to, over the medium to longer term, take advantage of accrued capital gains and to grow their portfolio. And if they can do it in an environment where interest rates are the lowest ever and that, they're starting to look at quite reasonable yields. I mean, the yields at the moment, if we compare yields, gross yields, to where the deposit rates have been. Now, deposit rates, of course, have fallen quite sharply as interest rates have fallen for borrowers. So, lenders are also having to pay or getting a lot less for their deposit of returns on their deposit. It's just under 2%. But the margin between gross yields and what you get as a deposit is now the widest it's ever been. So gross yields for property has actually been quite stable and hasn't reacted to any change in the underlying cost of money. So what I'm trying to say here, it's sort of immune to the vagaries. It's flattening out to the vagaries of the cycle, which is flattening out as well. So there's more certainty there. And there's some good, I think the bottom line here, Phil, is if you're an investor, you must start thinking a little bit more about the yield opportunities rather than the capital growth opportunities, which aren't going to be, I think, a lot different from capital city to capital city. I think the era of the hotspot is probably behind us to some degree.
And I want to get into how the different markets are performing, but you're talking about yield right now.
Yeah.
And what does yield mean? Yield means cash flow, right? It's money in your pocket to hold your portfolio over time so it grows in value.
Paying down your loan.
Yeah, all that sort of stuff. So if we're going to fast forward 10, 15 years from today, and when they talk about this part of the cycle, the 2018 bit of the cycle, the people who look back and the people who have set themselves up nicely and made money because of this cycle that we're in right now, what are they doing?
Well, I think they'd have a different sense of what a portfolio is. And I think there'd be less of the turnover and more of the building of a portfolio, if you understand what I mean. And I think that the other point is that you'll see more corporate involvement in residential investment. I think that they will recognise, because of course yield is always an important back end to corporate involvement in asset class investment. And I think that once they see that the roller coaster is moved out of residential, that they can then start thinking about doing a play for a yield return over the medium to longer term.
So you're talking about corporates building rental accommodation, which is big in Europe, right?
Well, I'm not necessarily saying build, but certainly becoming involved, but investing in it and to create portfolios as part of the mix. Now, we've seen the stock market come off over the last week. We were feeling, I guess, that the stock market may have been starting to build a base. Numbers were starting to rise above previous or get near to previous peaks, which was back pre-GFC. But now it's gone backwards again. It's still a lot of question marks over the global economy and the performance of our equity markets. And yet, as I think that we'll see more a view of property as an asset class, particularly residential property, as being a safe haven, and more of a blue chip scenario, because you're taking out the high and low roller coaster ride of the cycle. We are still chronically undersupplied. Those rental markets are terrible for tenants in just about every capital city market, except Sydney, which has gone the other way for various reasons. But
that'll come back though, won't it?
Well, look, it's the Sydney vacancy rates are now pushing up over 2.5% for both houses and units. Now, we're at the peak of the supply cycle in Sydney for units, particularly. No surprise there. We've seen an extra 12,000 first home buyers come into the New South Wales market since they changed the stamp duty concessions last year.
So they're not renting anymore, they're buying.
They're buying, And we've actually also starting to see, which is a little bit of a concern of mine, the top coming out of migration, net migration into New South Wales. It's certainly come off its peaks of the last couple of years. And there is a stronger net outflow of people out of New South Wales, particularly moving into Queensland at the moment, and that's
great if you've got property up there.
Well, that's right. But so I don't think it's not going to be great 10% plus great. It'll be great maybe 1 or 2% extra.
And let's do that. Let's go, because I know our listeners they want to go around the grounds. What's going on there from? Because you talk about death of the hotspot. There's no more hotspots, right?
Well, I think that a hotspot.
I hear mining's bouncing back. There's some great mining.
Oh, don't go there, please.
No. So let's leave that for another conversation.
Get a lot of trouble there, Phil.
Yes. I'll suck you into that conversation and see how. Okay. So around the ground. So we're talking stable markets.
Yes, but before we go, I just want to say that I think that the hotspots will be identifying the best places or the best property opportunities that are hot for yield and not hot for
capital growth.
So
when are we going to go into a new market which is going to be capital growth driven rather than yield driven?
Well, we would need a significant increase in interest rates.
Okay.
We would need interest rate increases, I think, of at least 2%. Now, if we had a 2% increase in our interest rates, because that would then give us the capacity to cut rates, so we would be building pent-up demand as that rate increase has impacted the economy. This is old school stuff.
Yeah.
And then we would build that pent-up demand because affordability issues would have confounded the market. And then we would have cut rates, and that would have released all that pent-up demand, and on we go.
So
That's
this will happen.
That won't happen. No, it won't.
It's not going to happen.
Well, if we raised interest rates now, we're at 1.5% now, correct?
Yeah.
So to raise it 2% would be 8 interest rate increases, right? Quite quickly. Now, we haven't had an interest rate increase
like that for a while.
Well, we haven't had one at all for 2.5 or for 2 years. So it's extremely fanciful stuff. We would have to have a booming economy or an Australian dollar, which was around 20 cents for that to occur.
And that's not going to happen.
Yeah. And as I said, we're very fortunate in this country. We're a very strong, diversified economy. Even though we have strong migration, we still are a very small country. We don't have a lot of people here. So we're always going to be undersupplied. We're always going to have too much demand and not enough supply in this country regardless. So let's certainly be positive, as I am, and it's a reality in terms of our circumstances. But, going forward, I think that certainly the circumstances are for higher interest rates would only occur if we had a massive boom, and that's not going to happen. I think this is the new future. And all I say to anybody who predicts higher rates or whatever going, you must substantiate that with a case. Now, all I do is whatever I say in terms of the future, I set up a case to do it, and that's all about robust research and analysis. And
that's why we need
you can't
people
just
like
say, you can't just say rates are going to go up because they went up before. Well, that's not analysis. That's a history lesson.
Yeah.
Right? You can't keep looking in the rear vision mirror to tell where you're going.
This is business as usual now. This is it.
Well, this is it. Well, I don't think. Well, certainly there's no case for higher interest rates, and those that have been predicting that have certainly shelved those predictions. And we're now starting to see more, as I say, that we may need lower interest rates before we get higher interest rates. Certainly things are not improving as they should. But having said that, right, that means that we're not going to get that bounce in prices because we just don't have the capacity to increase rates that would lead to a cut in rates that would give us the sort of growth we've had in the past cycle, particularly in Sydney.
We're covering some pretty complicated moving parts here from let's get you back in, Andrew, I think, because I'd like to actually drill down a little bit more into some of these theories, and I think it's really important for our listeners to actually understand how all these things jumble up together. And do you
want to look at those capital city markets?
I do want to do that, and I'm going to push on. They try and tell me to keep these a bit shorter, but
that's right.
I think this is all right. But we'll go back to that, and we'll do it in the future. But quick around the grounds, because it gives us some nice headlines for smartpropertyinvestment.com.au. Go and check it out. Let's start in Tasmania, which has been booming over the last couple of years. What's going on there?
Well, look, late coming to the party, of course, Tassie, but the key drivers of there have been a change in government, increased population, and we always should look at those population numbers. Net migration is a key. And, of course, value. I mean, the median there was ridiculously low, below compared to other capitals, below 400,000. And, the Hobart rental market basically doesn't have anything available to rent as we speak, and rents have gone through the roof as a response. So a little bit of catch up there from the Hobart market. I think the big picture generally is that we're going to see a convergence from house price growth in all capital city markets. I don't think we're going to see a lot of difference between the highs and the lows, maybe a couple of percent up, a couple of percent down. And this is part of that convergence because we don't have the interest rate driver. Capital city markets don't just sort of adjust over time to the same level they were when it all started, the cycle started. The impact of interest rates works its way through the system quite quickly, actually. And even though Hobart has come late to the party, it's not going to catch up to the extent where it will, match the same growth rates that Sydney had. And it's similar with other capital city markets. And if you've been down, such as Perth has been down and Darwin have been down, they're now flattening out, but they're not, even though their dynamics are a lot better, their drivers are a lot more positive, they're not going to catch up the lost years of negative growth that while Sydney was growing and Melbourne was growing positively. You understand what I mean? So this convergence So again, that's another positive factor because I think that what it means is that you can start looking at local markets in terms of their opportunity. But if I did look at, and I know we were supposed to go around the grounds, but if I was to look at the positives... I was going to ask you about
Perth and Darwin next, so you sort of covered them. But
let's
talk about the positives.
Certainly Perth has bottomed out, but it's a market that still needs some way to go. Vacancy rates in Perth now, the lowest they've been for a couple of years. They're certainly trending downwards. Rents are still at 10-year lows, but they've flattened out as well. So the direction is certainly positive for the rental market, which is always a good positive indicator of what's happening in the broader market over time. But it's a flatter market going forward. It will require a turnaround in migration. But even if it gets more positive drivers, it's not going to see the sort of growth that you would expect in terms of a catch-up market. So prices are going to remain, I guess, in a relative sense, quite subdued compared to the rest of the market. Darwin still has an issue with units. A lot of units. It's a small market, and of course that means it's a lot more difficult to absorb what's been a record growth period for apartment development in Darwin, but its economy still is quite strong. The key aspect there is to get more people into Darwin, and that's a question of a strengthening economy to soak up those apartments that have been a part of what's kept the economy ticking over. But mining, of course, agriculture and tourism is the strength of the Darwin market, and that needs to keep ticking over for that market to rebalance. But again, we're not seeing any great shakeout in terms of prices at rebalancing. I think Adelaide's steady as she goes. It's been always a market that's quite conservative. I think the mindset of the eastern states doesn't quite work its way into Adelaide buyers and sellers who just sort of keep on keeping on. Yeah. But migration is starting to look a bit more positive into Adelaide now, and I think that'll help keep the Adelaide market ticking over at around about the top performance of all the capitals, I believe, but only by 1% or 2% at best. And Brisbane, I guess, is flavour of the month at the moment. We've got vacancy rates in Brisbane now at 2.1% for houses and 2.1% for units. That's a sharp fall over the past year. In fact, it's well below Sydney now for vacancy rates. So excess rental stock's being soaked up quite quickly in Brisbane, despite that surge, which was a little overblown, the oversupply, scare campaign for the Brisbane market. Those units are now being certainly absorbed quicker than was expected. And, there's a lot of factors there. Strong migration returning into southeast Queensland, particularly from the eastern states, and particularly from New South Wales. Affordability is still very strong in Brisbane. It has a strong local economy as well. And, of course, it has those lifestyle and affordability advantages. So certainly I think that Brisbane, would be at the top of the pack in terms of growth prospects, but we're only talking 1% or 2% here because we don't have the low interest rate driver for people to push up prices, particularly given that incomes are flat. But there's no doubt that it's, the Brisbane market is pushing ahead with more demand than supply. But look, the positives for Melbourne and Sydney are still the underlying. Those markets still have strong supply and demand dynamics. Sydney has the strongest economy in the country, 80,000 extra jobs over the past year, surge in first home buyer numbers, and we've got to cheer that one on. It's always great to see people realising the great Australian dream, particularly in a market with such high barriers to entry with high prices such as Sydney. And we've seen the peak of the supply spot cycle in Sydney. Even though we've now at the absolute peak in terms of completions, we're seeing a considerable falling away of building approval. So migration, although falling away, is still quite strong. So demand will eventually push again ahead of supply in Sydney, but and it will remain the highest priced market. But it is now, together with Melbourne, which has even stronger demand drivers than Sydney in terms of migration and, again, strong first home buyer numbers, we really do have this crisis of confidence at the moment in both these markets. And, we're almost seeing an end or before our eyes, the withering of the spring selling season, and that'll become self-perpetuating because then we have the holiday break, then we have elections coming up, and this will only work its way into that sort of mindset that I'm concerned it's working its way into sellers and buyers generally of a wait-and-see approach to property. And I think that'll maybe have even a year to run before it settles.
Okay, so let's get you back in. Enjoy the chat. If you like what we're talking about, let us know. Just editor at smartpropertyinvestment.com.au. I quite enjoy these sort of conversations around all these microeconomic factors which influence property markets, and I know a lot of our listeners really get into it as well. So,
we've got, just before I go, Phil, just a quick plug. We've got a investor show coming up.
I was going to ask you about this. What's going on?
Investor show coming up on the 2nd of November in Sydney, and I'm going to be speaking there and part of a panel, and we'll have a number of luminaries there as we do have. And what I'm going to particularly focus on as we discuss is looking at some of those yield hotspots in Sydney and around the country. And there's lots of ways you can measure yield, and I don't think we get a real proper measurement of yield. We look at gross yield, and we tend not to identify actual yield returns from properties that are investment properties. We look at yield in terms of the measures such as the total median price of a suburb rather than the investment price.
That's the Australian Property Expo.
That's the one,
Okay.
yeah.
All right. So you can just Google that. You find it. I think it's 3rd and 4th of November in Sydney. I'll pop down and check it out.
Good on you, mate.
See what you're talking about.
Well, I've said it all today.
Going back, I find, as a property investor, I'm always about educating myself so I can make better decisions. That's the reason why we do this. So now more than ever, I think you need to be across the market and understand what's going on. But I think we've made it pretty clear that don't panic.
Well, nothing's going to change. That's my point. Nothing's going to change. So what are you worried about? And opportunity knocks.
Opportunity knocks. Let's finish with that. I like that. No, really enjoyed it, Andrew. Thanks for coming in.
Phil. Thank you for
we'll do that
asking.
again soon. And if you like what we're chatting about, look, plenty of podcasts. Go check out smartpropertyinvestment.com.au. We typically mix them up from having economists like Andrew in who has breadth of knowledge and comes from a different angle into the property markets all the way through to property investors themselves, whether they've got 1 property, 5 properties or a huge portfolio. So if you want to come on the show and have a chat about the way you see the world as a property investor, make sure you reach out to the team, editor at smartpropertyinvestment.com.au. We'd love to have you along. It's good fun and it's pretty relaxed, so go and do that. Remember to check out Smart Property Investment if you're not already doing so. Plenty of stuff on there. If you're not yet subscribing to our morning newsletter, so the first to know what's happening in property markets, so you can make these decisions. Just smartpropertyinvestment.com.au/subscribe or go to social media and search Smart Property HQ. You'll find us and see what we're up to. But hope you enjoyed that. A little bit longer than normal, but plenty of good info. I hope you enjoyed it, and we'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.